we can now look at mortgage-backed sector of the bond market. The mortgage-backed security sector, simply referred to as the mortgage sector, the bond market, includes securities backed by a pool of mortgage loans. We have residential mortgage-backed securities. These are mainly backed, or rather solely backed by residential mortgage loans. There are also commercial MBS, which are backed by commercial loans. We have agency loans and non-agency loans. Mortgage-backed securities and asset-backed securities are referred to as structured financial products. Residential mortgage-backed securities includes mortgage pass-through securities, collateral mortgage obligations, commonly referred to as CMO, stripped mortgage-backed securities. Note, the latter two are created from the mortgage pass-through securities. Repayment risk, which is the uncertainty surrounding timing of cash flows, is also a risk involved in this type of securities. Mortgage pass-through securities is a security created when one or more holders of mortgages form a collection, commonly referred to as a pool mortgages, and sell shares or participation certificate in the pool. When a mortgage is included in a pool of mortgages that is used as collateral for an MPTS, the mortgage is said to be securitized. Let's look at cash flows of MPTS. Pass-through rate differs from the mortgage rate due to service fee and other fees. The timing of the cash flows delays. Now let's have a look at weighted average coupon and weighted average maturity. In this case, weighted average coupon refers, or rather is a measurement of the rate of return on a pool of mortgages that is sold to investors as a mortgage-backed security. Whereas the weighted average maturity is the weighted average amount of time until maturities of mortgages in a mortgage-backed security. Here we also have an example. For example, suppose a mortgage pool was just 5 loans and the outstanding mortgage balance, mortgage rate, and monthly remaining to maturity of each loan are as follows. So according to this table, you're able to see we have one column with the loan, another column with the outstanding mortgage balance, another one with the weight in the pool. We also have the mortgage rate and monthly remaining period. So in this case, for us to be able to calculate the weighted average coupon for this mortgage, we simply multiply the weight in the pool by the mortgage rate for each loan, and at the end of it all, get a total. In this case, our total is 7.28%. Also, for the weighted average maturity for this mortgage pool, we simply multiply the weight in the pool by the months remaining and get the total. So in this case, our total, once we round off, we find it's 279 months. For example, here we also have already covered this as example in our previous computation. Now let's look at conforming Now, conforming mortgages are used as collateral for MPTS issued by agencies. They satisfy standards on size of the loan, loan documentation, maximum loan to value ratio. Non-conforming mortgages used as collateral are issued privately. These securities are supported by credit enhancement to obtain investment grade rating. Now let's look at measuring repayment rate. This can be done through different methods. So first, we have single monthly mortality rate, commonly referred to as SMM. We also have conditional repayment rate, commonly referred to as CPR, and we have the PSA repayment benchmark. Now let's do this practically. So for the single monthly mortality rate, we calculate this by getting, or rather by dividing, the prepayment in month T divided by the difference of the beginning mortgage rate balance for month T less the scheduled principal payment in month T. Let's illustrate the calculation of the SMM. Assume the following. Beginning mortgage balance in month 33 is 358,326,766. The scheduled principal payment in month 33 is 297,828. The prepayment in month 33 is 1,841,307. SMM for month 33 is therefore the prepayment in month 33, which is the 1.8 million, divided by the beginning mortgage balance of 358 million less the scheduled principal payment. And once we do this, we find that our SMM is 0.5143%. The SMM for month T is equals to the SMM, rather the prepayment for month T is equals to SMM multiplied by the difference of the beginning mortgage balance month T less the scheduled principal payment month T. Now let's look at CPR. For us to get the CPR, simply take 1 less by 1 minus SMM raised to 12. For example, suppose the SMM is 0.005143. The CPR is therefore 1 minus 0.994857 raised to 12. So in this case, you'll find that the CPR is 6%. You can also be able to reverse this, get the SMM if you have the CPR, where the SMM will be 1 less 1 minus CPR raised to 1 over 12. Illustrate equation 3. Suppose that the CPR is 6%, then the SMM will be equal to 1 minus 0.06 raised to 1 over 12. In this case, we'll be able to get the 0.5143%, which we had earlier. Now, the PSA repayment benchmark is a conventional adopted, rather is a convention adopted by market participants describing the prepayment rates. PSA stands for Public Securities Association. Well, let's look at PSA repayment benchmark. It is a convention adopted by market participants in describing the prepayment rates. The PSA benchmark assumes a CPR of 0.2% for the first month, increased by 0.2% per year per month for the next 30 months until it reaches 6% per year. A 6% CPR then holds for the remaining years. Slower prepayments take form of 50 PSA, accelerated prepayments 300 PSA, etc. This benchmark, referred to as 100% PSA, simply 100 PSA, can be graphically depicted, and the 100 PSA can be expressed as follows: where T less than 30, then CPR is equal to 6% by T less, or by T divided by 30. If T is greater than or equal to 30, then CPR is equals to 6%, where T is the number of months since the mortgages were originated. Example, for month 5, the CPR is simply 6% multiplied by 5 over 30, which in this case is equals to 1%. And our SMM will therefore be 1 less 1 minus 0.01 raised to 1 over 12. And if we do this, we'll get 0.00837. We can be able to do the same for month 30 and for month 31 through to the month 360. Next, we also have another example which you can be able to go through to have a clear understanding of how to compute the SMM CPR. Now, we also have average life. Mathematically, the average life is expressed as follows. We take a sum from T1 to the end of T multiplied by the projected principal received at MT divided by 12 multiplied by total principal. Now with this, we also have an example here below where we can be able to compute the average life. Now let's look at factors affecting prepayment behavior. We have prevailing mortgage rate, housing turnover, characteristics of the underlying residential mortgage loans. For prepayment risk, we have contraction risk, which is decreasing rates, or extension risk, which in essence increased rates. Now let's look at CMOs. When the cash flows of mortgage related products are redistributed to different bond classes, the resulting securities are called CMO. This can be sequential, accrual tranches, floating rate tranches, structured interest only tranches, planned amortization class, commonly referred to as PAC or PAC tranches, and support tranches. Now let's look at sequential pay tranches. Each class of bond is retired sequentially. For accrued tranches, most sequential pay tranches, at least one tranche does not receive current interest. The interest is accrued. The interest that will have been paid is used to pay off the principal balance of earlier tranches. If attractive to investors who are concerned with, pardon, it is attractive to investors who are concerned with reinvestment risk. Let's look at floating tranches. Some investors prefer tranches with floating rate. However, the collateral pays fixed rate, hence may be difficult to create a floating rate. This is achieved by creating for many fixed rate tranche a floater, the inverse floater combination. Here we have a hypothetical 5 tranche sequential pay structure with floater, inverse floater, and accrual bond tranches. In general, the formula for the cap rate and the inverse floater K is as follows. We take the inverse floater interest when reference rate for floater is 0 divided by the principal for inverse floater. Now here we also have another example which you can be able to go through to have a clear understanding of the CMOs. Structured IO tranches. A structured IO is created from a CMO structure where the coupon rate for at least one tranche is different the collateral coupon rate. You can also have an overview of this example, clearly understand this. Now let's look at planned amortization class tranches. Investors were still concerned about the perceived prepayment risk based on the substantial average life variability. PSC holders have priority over all classes in the CMO structure in receiving principal payments from the collateral. Support tranches absorb the prepayment risk. The PSC provides protection against both extension and contraction risk. Let's also look at other issues. First, we have creating a series of PSC tranches, PSC window, effective callers, and actual prepayments. We also have another highlight, one example, where you can be able to have a clear understanding of the workings of PSC bonds. We also have stripped MBS. These are MBS with two bond classes. Principal only class, where benefits when interest rates are low and prepayments occur. And we also have interest only class, which benefits when interest rates are high and prepayments rate is low. Let's look at commercial MBS. Commercial mortgage loans are non-recourse loans. Credit risk. Need to assess by computing DSC and loan value. You also need to understand the call protection. This is the protection at the loan level. The structure level where principal losses are impacted from bottom of structure. We also have repayment lockout, efficiency, repayment penalty points, and yield maintenance margin. Here you can also go through this example of the CMO and try and compute or rather solve this problem. Now come to the end of this course on real estate finance and investments. This course entailed practical approach towards real estate finance and investments. And it's also keen for you to note that some these products are currently not available within the Kenyan market, such as the last product which has been explained. And most of these concepts are more appreciated, especially within the American market, where most of these products were actually formed. But with time, they are currently being also integrated with financial markets within other countries. So at the end of this, we'll also provide a series of practice questions, and any additional notes will be updated as time goes by. Thank you for going through the course till the end. Please feel free to access the different courses provided through this platform.